Hello traders, Corey Mitchell here. We're going to look at 4 signals for finding a stock market bottom. We're going to look at a few signals that can help us know when it's okay to buy again, whether we're investing or swing trading. You can find me on Twitter at Corey Mitt, And this seems like a very good topic for this time. We have had a absolutely incredible decline in the S&P 500. This is March of 2020, and coronavirus fears are just wreaking havoc with the market, and we've sold off about 30% in a few weeks, which is pretty remarkable by historical standards. Not much else we can compare this to. So it's really important to have some tools that we can implement for helping us know when it's time to buy again. So I'm going to look at 4 tools. I do have a free swing trading group, Stocks Forex Futures on Facebook. You can look that up. Ask to join. It's all free. Post in here quite regularly. So we're going to cover a couple of things that I've posted about quite a while ago, March 3rd, and I've discussed these things in the past so that we wouldn't have been caught in this big decline, and we wouldn't be buying yet as the price is still going on if we follow these indicators. So they help us stay out while the price is declining, but they also help us get in pretty close to the bottom, about 4 to 7 days after the bottom. So that is, in my opinion, about as good as you can get. These, of course, they won't work every single time, but they have been very reliable, especially if you combine them all together. So any one of these may not work 100% of the time, but using them overall, I found them quite reliable. And then, of course, you still want to use your own risk management techniques to make sure that once you do start buying, you still have an exit point to get out at. So let's start with a couple of these. Be switching back and forth between charts and slides. First off, just a disclaimer, give that a read. Of course, trading involves significant risk. Don't take anything that I'm telling you as personal investment advice. So to start buying investments, we're going to look at 2 indicators, and both of these are made up by other people. I take absolutely no credit for them. They're just some of the best techniques I've found for isolating bottoms based on looking at your charts and looking at price. So we're going to talk about Lowry upside days, and we're going to talk about follow-through days. So Lowry upside days are from a firm called Lowry Research. They have a free paper available. I'll give you the link in a little bit where you can download it, read up on this strategy. And what we're going to do is we're going to look for a day where volume is 90% to the upside and points are 90% to the upside. I only look at the volume one because it's quite accurate, and I'll show you where you can find the volume data. And we're going to use the S&P or the NYSE. I use the NYSE data. So we're going to look at how many, when we have 90% of stocks or 90% of the volume moving to the upside in a day. That gives us a pretty good idea that a lot of movement to the upside is coming into the market. A lot of buyers are coming into the market, and we may be close to a bottom. These typically occur within 5 days of a market bottom. As I mentioned, they're not 100% reliable, so we want to use another tool. A follow-through day is a sharp move higher that occurs 4 to 7 days after the low. So if we go back to our chart, we have these big drops, and we're going to wait for 5 to 7 days after a bottom. So if this was the bottom and we started to rally, we're going to wait for a big move 4 to 7 days after that bottom. That move, in this case, is going to have to be at least as big as some of these declines or rallies that we've seen in the past, and we want to see volume up at least where it's been recently. That's going to let us know that not only have we had a small rally, possibly a Lowry upside day as well, but now we're seeing another big jump up in price and in volume. So it lets us know that it wasn't just a short-term blip where people came into the market like this one Here we had a little bottom, if you can see where my cross is there. Little bottom, and then we have a 3-day rally where price kind of holds up above, and then by the 4th day we're starting to sell off again. So by waiting for 4 to 7 days, it lets us assess how much strength there is in that rally. So instead, if this would have been your 4th day and then you had a big burst to the upside, that most likely would have indicated a bottom was in, especially if this was a Lowry upside day. We did have a Lowry upside day right here, this big white bar. I can zoom in a little more here. This big up bar, this one here, was a 90% upside day, meaning almost the entire volume of the day was in stocks moving to the upside. And then we had a big sell-off the next day, 90% downside day the following day. So that reset the thing. We may still see a bottom within 5 days of this, but in my mind, we basically reset. We're waiting for another 90% upside day and then another follow-through day. So a little bit more information on those. You can go to LowryResearch.com, and they have a lot of free reports here. This is the one you're looking for: Identifying Bear Market Bottoms and New Bull Markets, a study of 90% days. Definitely worth a read. It's several years old, but a great article and a lot you can take from it. So I'm not a subscriber to these guys. I'm not endorsing their service. I have previewed it or taken a trial. Definitely some top-notch stuff, but I'm not endorsing it at all. Just directing you toward this free report that they offer that they'll email to you. The next thing to look at is the follow-through days. If you go to investors.com, as I mentioned, this is Investors Business Daily. This is one of their techniques developed by William J. O'Neill, who wrote the book How to Make Money in Stocks. Great introduction to stock trading if you are looking to get started, or you're an advanced trader and want to solidify your method a bit. This is an excellent book to look at. $13, well worth the $13. So follow through day, it talks about what the basic elements are. I've highlighted already 4 to 7 days after an attempted rally. So we've started to move up off what could be a low, possibly a Lowry upside day. And that might be the bottom, it may not be, but either way, we've seen that Lowry upside day. Potentially, we've also seen the price starting to rally off a low. If we get a big rally 4 to 7 days after the low, that's a follow-through day. That is when I'll start looking at buying. Once I have those two signals in place, the follow-through day I view as a bit more important, simply because the Lowry doesn't always occur, yet almost always will get a follow-through day. At some point during that rally, you're going to get a sharp burst to the upside on big volume and big price moves. They say that the index should move up at least 1.25%. 1.25% in a sell-off like this is absolutely nothing. So you have to take context in mind. We're moving between closes and like high and low each day, factoring the prior close. We're moving about 5 to 10% a day for many of these days in a row during this decline. So a 1% rally is absolutely nothing. What we're probably going to need to see is a 5 to 10% rally, or even more, and that would be our follow-through day. Zoom back out a bit here. So those are the two indicators that are going to let us know how to isolate a potential bottom. That lets us know when we can start buying those stocks that we've thinking about investing in, or if maybe we're just investing, we're going to start moving some money back into our account. We've been in cash or bonds or whatever it's you've been in, and you want to start transitioning that money back into stocks. Those are two signals you can watch to do it. If you're more into swing trading, or you want to wait for more confirmation in your investments, we can add two additional things in. So in order to aggressively start swing trading on the long side, this is when I view the odds most in our favor of pretty much any stock going up, or at least as good odds as you're going to have. I'm going to look for two things. a high on the NYSE advanced decline line, and we're going to look for more than 50% of stocks. I don't know why that says NYSE percent. Above 50% of NYSE stocks above their 50-day moving average. So let's look at what that looks like. Go back to our stock charts chart here. Again, these are both free. Stockcharts.com. Both these indicators can be added. I have listed the symbols on the prior page, and you can also see them here. $ NYA50R and exclamation point AD line NYA. So the 50%, to give you a little bit bigger perspective, let's zoom out a bit. So this y-axis on the 50R line is the percent of stocks above their 50-day moving average. As most of you know, a 50-day moving average is simply the average price over the last 50 days. So it's like a short-term trending indicator. It lets us know, the 50-day moving average lets us know, is this price above its average? So this blue line represents the 50-period moving average, or 50-day moving average in this case, because we're looking at a daily chart. So it just is a very simple indicator to let us know if we're in an uptrend, or if we're below it, maybe we're in a downtrend, or the price action is choppy. So for swing trading, ideally we want to be going long when overall prices are rising. So this isn't only related to the S&P 500 or an index. This is telling us how many stocks in the entire New York Stock Exchange are in short-term uptrends or above their 50-day moving average. As you can see right now, my cross point there is at about 50%. Only 4.5% of NYSE stocks are above their 50-day moving average. So nearly everything has been just cratered with this massive decline that we're seeing, represented by the S&P 500 here. The S&P 500, of course, is just a basket of 500 stocks, so it represents what most stocks are doing. And we can verify this by looking at the NYSE and seeing, yes, most stocks are in downtrends, just like the S&P 500. So for me to get aggressively long in buying stocks, I'm going to wait for this to move above 50. When it's above 50, at least half the stocks on the NYSE are in short-term uptrends, which lets us know that even just randomly picking a stock, you're more likely to make money by going long. If you try to go long in a random stock here, only 4.5% are in uptrends. More than likely, you're just going to get hammered as the price keeps declining. So it's just an odds play. You can see when this indicator is above 50, we have these sustained uptrending periods. They're not always sustained. This one, it went above 50. It was there for several months. But if you had gone long on like a breakout trade, at least more than likely the stock you were in would have been going up as opposed to be going down, because more than 50% of stocks were rising during that time. As you can see, this falls off as the index falls off. The other one that we want to look at is the NYSE advanced decline line. My minimum threshold for this is that it needs to make a higher swing high. So here we can see we've been falling, making these little gyrations. So the price would at least need to make another swing high right above this level here, and that be the first one. So this one's going to take a little bit of time to get up to 50. This is the very first indicator. I would wait for at least this. You're going to wait for Lowry upside day, a follow-through day, and then at least the NYSE advanced decline line to make a higher swing high, so that at least we're starting to move back up. Ideally, you want to wait for this NYSE 50R or NYA 50R to get above 50% or above the 50 level to indicate most stocks are trending higher again. So those are the 4 tools that I use to help keep me out during these massive declines. They also avoid me getting in too early. A lot of people probably got suckered into like some of these really big rallies that happen. But by using all of these combined, by waiting for the follow-through day as well, waiting a few days after a big rally to see if there's any push to the upside again or follow through. You're really going to save yourself from getting run over by buying here and then instantly having to sell a couple days later. By using these indicators, you're going to be buying when prices are rising as opposed to still cratering. And we're still getting in pretty early. So a lot of people I want to buy on the way down because I want to try to get the best price possible. That's going to be very difficult. And here, using these indicators and the Lowry days and the follow-through days, we're still going to get in typically within 4 to 7 days of the market bottom anyway. So we're going to get in very close to the bottom, but we actually have some very reliable indicators pointing that a bottom is potentially in place, and we are starting to see movement back to the upside. Once we start to see the advanced decline line move higher, you could also watch for this 50% line to start moving up. The best conditions, I think, for swing trading are going to be when we're above the 50. That's when you're going to see your most consistent performance likely, because most stocks are moving up. But if you've really got some deals in mind, you could start looking at those once the 50R also starts making higher swing highs. So wait for these two to start making higher swing highs, ideally above 50. And that's how we're going to find our stock market bottoms. So I've put here the resources, wallstreetjournal.com, advancing divided by total. We didn't actually cover that. Let's cover that right now. So the Wall Street Journal will give us our advancing and declining volume. So we're going to have two numbers here. If we go to wallstreetjournal.com, market data, stocks, markets diary, we're going to have a few different numbers here for the NYSE. We're going to use these bigger numbers. These are the smaller volume numbers. We're going to use these ones, which cover basically all of the volume. And we're going to divide advancing volume by total volume. If it's greater than 0.9, that tells us we're in a 90% upside day. If it's 80% or above, that's still relevant, but you need two back-to-back 80% days to equal one 90% day. So you basically have 2 days of really good volume as opposed to one huge day of upside volume. So both are reliable, but in some cases you're going to get two 80% days, in other times you're going to get one 90% day. So you're just taking advancing volume divided by total volume. Greater than 0.9 lets you know if you have a 90% upside day. So these are all free resources. The Wall Street Journal gives you your 90% days. Big volume and price thrust 4 to 7 days after a major low tells you if you have a follow-through day. And again, take context in mind. If you're dropping 5% a day, you're probably going to want to see at least a 5% or greater rally on your follow-through day. And on stock charts, we're looking at the 80 line NYA and NYA 50R, remember the exclamation point, and the dollar sign. So those are 4 free ways that you can look at finding stock market bottoms. Hopefully we are near one in this market decline. We'll see. We'll wait for the signals. In the meantime, I hope you're staying safe and that you're finding some good opportunities out there for when the stock market does turn. In the meantime, happy trading.